Here we are at part 3, and we are looking at insurance, but first I want to go over some of the terminology I did not go over in class, and let's look at gift causa mortis. Interesting word, yes? It's sort of like chattel. So gift causa mortis is it's a gift given when somebody is on their deathbed, or they feel that they are on their deathbed. Then they will start giving gifts to their relatives or as an inheritance. So that's one. The other one was gift inter vivos, and that one is a gift made during the lifetime, not in contemplation of intimate death, but it's just a regular gift that one would give. Just terminology that is used by the law field. Mainly it's Latin. So the other one I didn't talk about was constructive delivery, and you can hear my puppy in the background. And that means when you physically deliver a gift. Constructive delivery is what that is called. So I think I've pretty well covered all of those now. Transferring it to somebody else. And it's called risk management. You would, if you buy a brand new car, you are going to get insurance on it to cover the cost of that car in case you have an accident. So you transfer the risk of loss to the insurance agency. We have many insurances, and they are classified not by the amount of Let's see if this is working. It said my mic quit working. So this is the type of insurance. You can get accident insurance, which covers any losses or expenses suffered by the insured caused by accidents, just physical accidents. You can also get something just called like cancer insurance. So if you get cancer, it would just cover in that case. All risk insurance covers all losses that may be incurred, anything that's not excluded. Typical exclusions, they say here, are war, pollution, earthquakes, and floods, which are basically considered, at least the last two, acts of God. I guess the first two could be acts of man, if you want to look at it from that viewpoint. You can obviously get automobile insurance. You can get casualty insurance, which insures you as a result of being held liable for personal injuries or property damaged. You can get decreasing term life, which means you pay the premium, but the amount of the award goes down as you get older. You can get disability insurance that would pay in case you were hurt or couldn't work any further. Employer's liability insurance, we've kind of talked about that. For injuries that an employee would suffer. A fidelity or guarantee is a protection against losses in trade or losses caused by the dishonesty of employees, say fraud, or breaches of contract. So you can actually insure against that particular hazard. You can get fire, and we know about that. Floater insurance is for movable property as long as it's within territorial boundaries. Let's say for a trailer or an RV, something that is movable and moving around, or maybe even a boat. And then you can get homeowners insurance, which protects your house and your personal belongings in case of fire or wind damage or a catastrophic event in the area, as long as it's not an earthquake. I mean, a lot of times you have to look and see if it includes flood and earthquakes. types of other insurance down here are key person. A lot of people, if you are a CEO of a company or somebody who's very important to a company, you will be insured for that company. There's liability insurance, there's life insurance, just regular life insurance, and there's major medical and malpractice, we've talked about that, and then term life, which is for a specific amount of time. So there are all kinds of classifications of insurance, and my guess is there are many more out there that we're not covering right now, or at least this book is not covering. To be able to insure something, you have to have an insurable interest in it. And what that means is, let's look at a life insurance. If you were to take out a life insurance on somebody else, you have to have the reasonable expectation of a benefit of having those people stay alive. And that benefit must exist at the time of the insurance. Another way of looking at it, property insurance. If you have property insurance, you have to have a reasonable, it has to have value, and if you would lose it, then you would lose that value. So there has to be a monetary value placed on it, and you have to be the owner of that property. And you would derive that benefit if that item was lost. Then that would be a loss to you. So that's what they call an insurable interest. There is some terminology, insurance terminology, I guess we should probably talk about. I think first we need to go do a question, though. What do you think? How about you do your question, and I'll finish this little thing up, and I'll meet you back at terminology. How's that? Okay, here we are, terminology, and we're going to look at insurance terminology. Policy is a contract, a premium is a payment. You probably know all of this. An underwriter is actually the insurance company or the person or the company that writes or supports the risk for your property. An agent is somebody who sells the insurance. A broker is usually the person who owns it or who has a broker's license that works through the insurance company. And an agent owes a fiduciary as a fiduciary relationship to the broker, not to the insured. So they're going to be loyal to the broker, and even though they will sell you insurance, their loyalty lies with the company. Should we do another question? Oh, let's wait for decided not to do a question yet, so let's look at insurance contracts. What does that contract look like? Well, first of all, your first guess is it's governed by contract law, and that would be correct. There's an application date, or there's an application, and then once the application is accepted, you'll have an effective date of when that policy will take hold. Under some circumstances, they can put a binder on the application that says it's good until approved, but that is only if you ask for it and if you are in very good health. And even then, if it's life insurance, that it will cover you until you have that physical. If your physical comes back, say not stellar, then they may not allow you to be covered by that policy. Also, if something were to happen between the application date and the effective date, and you had a binder, you would have to have a proof of good health. And again, that's all written in a contract so that you could understand it. There's a co-insurance clause, it's called, and that's for house insurance or real estate insurance. And you need to have, if you don't have at least 80% insurance coverage, if your house is only partially damaged, it will not pay full amount to fix it. So you have to be real careful about that. Most insurance companies will say you need to insure it for at least 80% of the coverage that'll cover the cost of rebuilding that home, so that this clause will kick in and give you full value for your house. Most insurance companies are really very careful about that because they like to take good care of their clients. There's an incontestability clause, and that means it can't be contested after a certain period of time. Let's say you've had insurance for 3 years, and this will be written into the policy, into the contracts. And after that 3 years of time, they can't cancel the insurance. I mean, it can't be contested. And then looking at cancellations, the insured can cancel it at any time. The insurer only under special circumstances. One is non-payment. If it's an automobile insurance, it's suspension of license, or if there was misrepresentation when you took out the policy. And another thing, if there's a sudden increase in risk to the insurer from you for insuring them, they have the right to cancel that. And then if you've made a fraudulent statement. Let's see if I told you right about that incontestability clause. Let's go down here and look at that. Proof provides that after a policy has been enforced for a specific length of time, 2 to 3 years, the insurer cannot contest statements made in the application. I take that back. So in a way, maybe they can't cancel it if there is fraud in the statement. Okay. I was thinking that didn't quite sound right. The other one is the interpretation of a contract. Many courts will interpret that for you. If you come to not being able to settle a claim, the court system will help you interpret what that insurance policy is saying. The courts pretty well realize that the insurance policies are written they're very dense, they're very difficult to read. So the courts usually will lean toward the insured more than the person insuring you, and they will help you interpret that contract. Now we'll have a question. And I guess I should put a question mark here just so I can remind myself we have a question. So hop over and do your question. And when you get back, we'll talk about the duties of the insured, the duties of the insurer, and the defenses against payment. So hop over there and then hop right back. Duties of the insured. The first thing you have to do is you've got to pay your premiums. You have to notify the insurer of a claim. You need to cooperate with the insurer. You can't say I have a claim and then never talk to them again. And you can file a tort claim in court if you feel that the insurance company is acting in bad faith. So you're, as an insured, you have many rights, and you're covered fairly well as long as you fulfill your duties. Now, the duties of the insurer are a duty to investigate when you have a claim. They can't just say, oh yeah, right, and then not talk to you again after you filed a claim. They need to make reasonable efforts to settle a claim. And they have a duty to defend you if it is in a claim of somebody against you, such as a car accident. And then they also have the duty to pay legitimate claims. So, it's sort of a give and take on both sides. If both the insurer and the insured are transparent and fair, there should be no problems with a claim or with buying insurance. Now, there are some defenses against payment. Those would be fraud, misrepresentation when you made out an application, but if it was after 3 years, in most cases they can't contest it past that point. If there is a lack of insurable interest, which means there is no loss to you, or if, let's say you took a life insurance out on somebody that had no connection with you and they passed, that would be a non-insurable interest. And then illegal actions by the insured. If you were in the process of an illegal action and were harmed, the insurance company may have a point of not paying. So that covers insurance. It's an interesting area. It's an area even in your personal life that you're going to encounter. I think we'll do another question here, and then we're going to wrap it up. So I hope you've enjoyed this part of part 3. It's an interesting, like I said, interesting information, because you are going to be able to use it in your personal life, not only your business life, but your personal life. So see you in class.